The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the May edition of Digging into the BI. This is where members from the Maryland chapter and the DC regional chapter get together and look at the latest issue of Digging into the BI magazine. And we take a look at the featured stocks. And this month, they are CACI or CC, I think, and then NextEra Energy, along with Waste Management and Green Brick Partners. So we're glad you're here. Welcome, and let's go to our next slide. This is the standard disclaimer that we talk about inside our community, and that is that we're doing this presentation for educational purposes. We believe, as Better Investing does, that you should be able to conduct your own review and analysis of any companies, and that while we discuss these securities and stuff, they may be in our personal portfolios and the like, but we do recommend that you do your own work. If we're showing you any websites or any locations outside of the BI stuff, don't worry about it. It's just, we're not endorsing or promoting it. We're just showing you how we've done it. And as you see in these slides, anytime you see a blue hyperlink, if you have the PDFs of this, will take you to the location. But we are recording this and we'll put it up on our YouTube page. And that blue underline is to our YouTube page. Next slide. So again, everyone here is pretty much regulars, but in case this is up on the great World Wide Web and you're wondering who Better Investing is, here we are. We're an investment education organization. We're focused on long-term fundamental investing. And again, if you don't know what those are, again, the blue underlines will tell you where they are. All of us that are presenting tonight are volunteers in either the Maryland chapter or the DC regional chapter. We're glad you're here. You do not have to be a member of Better Investing. You do not have to be a Better Investing member from Maryland, DC, or Virginia. I see there's a lot of people from outside those two states in the District of Columbia. We're glad you're here. Please share the slide deck, the PDFs with your club members, friends, and the like. We're just here to be able to work together to be able to help educate people in long-term fundamental investing. Next slide. Here's the YouTube page I was telling you about. We've been getting good, steady growth. We're not like any of those big influencers that get, millions upon millions. We're trying to get over 250 subscribers, but we've been moving up steadily. But you can be able to find us if you go to YouTube and do Digging into the BI, or you can be able to just see the hyperlink up at the top. All of the presentations are up there for the last 2 or 3 years, maybe even 4. And all we ask for you to, in return for getting this free education, is over on the left-hand side, like the video, share the video, and subscribe to the channel. As you can see over on the right-hand side in the blue, each webinar is sort of organized into chapters. That's how YouTube sort of breaks things up. So if you want to come back and look at one particular presentation, you can just be able to advance to that location and you can go there. That's what a chapter is called in YouTube world. Next slide. We haven't had this in a while, but this for troubleshooting and stuff. But the biggest thing out of all this is a green arrow sort of at the bottom, and that goes over to the handouts. And over there in the handouts, we have the PDF for this, and we also have a PDF for the 4 completed SSGs. So you can see what the presenters came up with in terms of their presentation. Next slide. So why are we doing this? Well, we're part of the Better Investing community, and we like to be able to show beginners, people that are uncertain of their judgments, things like how to use the stock selection guide. Sometimes we'll talk about the PERT report. We're trying to be able to use the best practices of a long-term investor, fundamental investor, in fact, and that we're also trying to be able to do we are doing a joint program with the 2 Mid-Atlantic chapters, and we're promoting our model clubs. And we also want to promote your club if you live in Maryland, DC, or Virginia through the Club Connect program. It's just a way for us to be part of the Mid-Atlantic community. And again, you do not have to be from that part of the country to participate, but that's sort of the purpose of what we're trying to do here. Next slide. So in just over an hour, we're going to go over 4 stocks, the 2 featured stocks, which come from the member-only magazine. They're called the Stock to Study and Undervalued Feature. We're going to have 2 more presentations. They can either come from personal experience, that's where one of them is coming from, and the other's coming from a screen. But you can also find that there's a lot of overlap. They can be in the ticker heat map. They can be in the BI Top 200. We've had a lot of those the last couple months, and also from other chapters that are doing things. So just keep involved that, if you're in this community, you're going to hear a lot of these stocks over and over again. Next slide. So here's how you can be able to see what's coming up. As you can see where the red circle is, that's for CACI. And again, Lee will correct me when I get it wrong. And then NextEra Energy. Those were done on March 3rd, but you can see they already have the June and July featured stocks up there. So we can see in June, next month, they're going to be Lowe's and Icon PLC, and they already have the July ones up, which are Meta and Google. So that ought to be really quite interesting. But again, you don't have to be a BI member to see this part of the website. And again, you can share this with others. And now that you know what's available for the next 2 months, go ahead and do your own SSG on any of those companies. So when we get to the end and we have discussion, you'll be able to participate more fully. Next slide. Also, if you're a BI member, you can get the email, you can get newsletter announcements from headquarters. And you do that by going where that red circle is. It says My Account. And then down on sort of the lower left-hand side where you have the green circle, you go to email and product subscription information. If you click on that, it will open up the screen capture on the far right, also in the green box, and we'll be able to show you how to sign up for local chapter news. That's where the arrow is. But the weekly e-newsletter is the one that's highlighted in yellow. Make sure to click on that before you hit the Save Changes that I have circled down in the lower right. Next slide. So here's what the latest weekly newsletter looks like. It came out on Thursday, close of business. And again, if you've signed up for it and you're not receiving it, check your spam filter. But again, this is how we can be able to see a lot of the stuff that's coming up. Where that sort of light orange arrow is up at the top right, that's talking about the upcoming virtual BINC. That's our national convention, and every other year we have it virtually, and the other time we have it in person. So this year it will be a virtual one. You can be able to take a look at what the schedule is, who's presenting, what classes are up, to take a look at it. And then also, if you look down at the bottom, I had the Learning Center where they're showing you how to use return on equity. But they have stock ideas in here, screens that you may not normally have seen, and also announcements for our popular ticker talk and stock ups. So use this and incorporate it as you're looking to be able to become a better investor. Next slide. You can also connect with us locally on our Facebook page. We have a joint one between the DC chapter and the Maryland chapter. You do not have to be either a BI member or a member in this community to participate in, but that's where we end up sharing a lot of the stuff that's going on. And if you're in this, if you are in Maryland, DC, or Virginia, and you're doing something with your club, go ahead and if you're putting up on Facebook, go ahead and tag us, the Maryland and DC chapters, and that way it will show up on this page as well if you want to be able to promote it. So consider it as a way to be able to do further promotion of your club. Next slide. The Maryland chapter had a really nice event this Saturday. I couldn't make it because work called, but they had a wine tasting this past weekend in Laurel. I didn't get a report on it. Some people I know were supposed to go up, but they couldn't make it. But it was a great way to be able to talk about local events that's going on, as well as being able to have some wine. The other thing is that the Maryland chapter has a stock pickers contest that's been going on. And actually, one of our presenters for tonight, Ken Williams, is actually the current leader in that. So if you happen to live in the Maryland chapter, which is everything except for Montgomery County, Maryland, you're in the Maryland chapter and you can participate. It's great fun and bragging rights and stuff like that, and it doesn't cost anything. Next slide. And Cheryl, why don't you tell us what's going on in the DC chapter? Are you muted?
There we go. We have two model investment clubs, the Model Investment Club of Northern Virginia, otherwise known as McNova, and they are on the third Tuesday of every month. And we also have MCMC, which stands for Montgomery County, Maryland Model Club. Also, both of those are virtual, as are most of our events, but we have a special event coming up that I can tell you about. We will have in our annual meeting Sam Stovall, who is the lead analyst for CFRA, which is the research arm of Standard & Poor's. He will be our guest speaker, and it starts at 10:30 Saturday morning, the 21st of June. Please come and spread the word and attend because it should be very interesting. Sam is always a very interesting speaker on what's happening in the future and the current stocks. Back to you.
Okay. Let's go to our next one. So back to you. Actually, no, this is, I think we're going to let, is this?
Lisa?
No, it's you because you're presenting tonight. So it's all you.
Okay. All right. This is the Model Investment Club of Northern Virginia, which I was just speaking of. It started in 2008, and we currently have 14 partners. The next meeting is going to be May 13th, which is the second Tuesday of the month from 7 to 9 p.m. And there is the link to attend. It's an online virtual club now. And for education, we're going to do a deep dive into defensive stocks. And the stock to study is Powell Industries. And there is our, where you can get in contact with us at the bottom. Now back to you, Kevin.
And Richard, why don't you tell us about your club?
Okay. Well, we started in 2017. We currently have 6 partners. We meet virtually on the third Wednesday of every month at 7 p.m. And our education this month will be BI Magazine as a resource. And the stock to study is Industria de Desano Textile, symbol IDEXY.
Thank you. Let's go to the next one. And this is the other one. This is Happy Destiny Investment Club. I'm going to be presenting in absentia for Ken Williams. Ken couldn't make it tonight because of a family issue. But we meet on the third Friday of every month. And we're still trying to figure out what our education's going to be. It says April 12th, but it's the third Friday in May. So whatever that is, I didn't get it right. And our stock study is going to be United States Lime and Minerals. And there's a picture of 6 of the 7 of us at one of our social events. And we like to get together socially because we are an online club so that we can see each other and interact with one another. So we like to have twice a year social gatherings where we have a potluck. Next slide.
And Kevin, our education is also going to be the deep dive into defensive stocks.
Okay, well, very good. I think we know who's going to be presenting both of them. Cheryl, tell us about Club Connect.
Okay, Club Connect is a new program set up for people to go in and fill out forms. If they're looking for new members, they can advertise that way. And for people who are individual investors who would like to join a club, also you fill out the forms and you will be listed there for people to come and see when they are on either side of the looking for members or looking for a club. And it works very well. So please, I know most clubs are looking for their members. Go in and register with Club Connect.
Thank you. Let's go to our next one. So again, since this is digging into the BI, we want you to be able to dig into your magazine. You can get it electronically over on the left-hand side. You can get it on an app, on a tablet. I know most people usually like to wait until they get the old-fashioned paper stuff, but you can get it several weeks in advance. I haven't received yet my May issue of BI. It tends to be sometimes a little slow up here in Baltimore, but I did get the electronic one 2 months or 2 weeks ago. So it's a great way to be able to take a look at things in advance and consider it. Let's go to our next slide. The other thing is that, the featured stocks that we have, they always have additional resources for it. And if you go to the Learning Center in BI Magazine, where that red circle is, or red arrow is over on the left-hand side, where it says analyst reports and other resources, that's where you can find additional information on the featured stocks. And again, that's the undervalued feature and the stock to study. If you haven't signed up to be able to get the Better Investing for Mobile Devices, there's the green arrow right there. It's a little bit different sign in than what you have for your traditional one, but it's pretty self-explanatory and you can walk through it to see it. Let's go to our next slide. So again, we're looking at digging into the BI. This column sort of caught my interest today. It's a fundamental investing column. It's a regular one in there. Invariably, a lot of people have a hard time trying to figure out PEs. And even if you're a little bit more experienced, it's sometimes good to go back to the basics and be able to understand PE ratios. In fact, I have a upcoming club visit that said they wanted to be able to figure out a little bit more on PEs. So this will be something that we'll use as a basis for it. But also there's going to be a couple classes at Virtual Bank, hint, hint, please sign up for it, where they do talk about PEs and the like. But here's again the quotation from it is that the lower the PE is generally considered a better value. Somewhere in the 20 to 25 range is considered good. Again, it's unique to each company. So again, 20 to 25 may be the universe average of all the stocks, but you can see growing companies may be higher, and some companies like particularly banks and construction companies, residential construction companies tend to be on the much lower end. But it gives you an idea of what to take a look at. So consider going back over this or sharing this with people in your club to see what's going on. Next slide. This caught my eye. This is right after we have the top 200 stocks in the April edition. The May edition always likes to be able to feature club anniversaries. In our chapter, the DC regional chapter, we've been doing a lot of club visits, trying to be able to get people excited and to be able to also give them a little bit of we're giving them a little bit of discount on their attempt to be able to go to Virtual Bank. And all the ones that are highlighted in yellow are either from Virginia, DC, or Maryland. And again, these are companies that are clubs that are anywhere from, 35 years to 70 years old. So kudos to all of them. I recognize a couple of them, but not all of them. And that means we need to find them and get some of them to participate in this program. But again, look at how many clubs are still around even at 70 years. Next slide. The final thing is that to always look at the investor education column on page 51. They have a lot of events. Many of them are free and online, so you don't even have to be there. You just have to make sure you know what time zone they're in so you can take a look at it. So I'm featuring here the North Florida chapter. They have a regular sequence of stuff going on. I could have just as easily have put the South Florida chapter. They're both two very active chapters on opposite ends of the state that do a really nice job of being able to reach out to folks. So please look at this. And this is another reason because some of these events have already transpired. And here we are on Cinco de Mayo. If you use the electronic version of the magazine, you can find this 2 weeks in advance so you can be able to be ready to go to those things. Because again, some of these are listed as late April. Next slide. So we're done with all the preliminary stuff. Now we're going to do two stock presentations in core. And the first one up is going to be waste management. Ken Williams is supposed to do it, but he's been tied up with some personal issues. So I'll just sort of read his for it. But he's been one of our steadfast people all along. And he has waste management in his own personal portfolio, and it also shows up on the ticker heat map. And then also stepping up at the last minute for us, Lee Outlaw is going to be doing CACI International, which is the stock to study for this month. So let's go to the next slide, and I'll tell you what Ken has for waste management. So again, as I said, it's in the ticker heat map and his personal portfolio. He likes it for the income component of it. And let's continue forward. So again, he also found it, like I said, in the ticker heat map. You can see the red circle sort of in the center and off to the right there. This shows up that it's one of the top 100 stocks in there. And again, we were talking about this in our club that we wanted to be able to find more stocks that were in the industrials because we were sort of overweighted in technology and healthcare and financial services. So he said, let's take a look. And he owned this one. So he said, I'm going to be able to dig in on this one. Next slide. So again, waste management in the industrials, it's a large company. And it's the largest integrated provider of solid waste services in the U.S. They have 263 active landfills, and they have 332 transfer stations. I know that they originally started out at one point, I know in the history has some more stuff, that they were doing waste hauling of municipalities in the Chicago suburbs. But it has a great financial health grade. You can't get much better than an A. And that look at it, if you bought it 5 years ago at $10,000, you would have more than doubled your money. So even though this doesn't always show up as one of the really exciting companies to take a look at, there's a lot to be able to say about waste management. Next slide. So again, here's some of the history. Some of the garbage collection that was done goes back to 1893. Again, this was in the Chicago area. That's Harm Huizinga is how you pronounce that last name. And his grandson, with the support of a couple other investors, was able to found what's now Waste Management. They consolidated a lot of waste management municipal contracts around the country, again, starting in the Midwest and building it out. They continually acquire other companies, and they're now the largest since 1980, the largest waste hauler in the U.S. And then in 1998, they merged with USA Waste Services, and that's how they now operate as Waste Management, Inc. Next slide. So again, here's some of the things, if you look at it, the industrial timeliness ranking. This is ones that are going to look pretty good over the next 6 to 12 months. And this is from Value Line in their environmental industry survey. And it talks about, again, the really major player against waste management is Republic Services. And again, because everyone needs to get rid of their waste, they basically are a steady recurring business that goes on. As it says in here, both these companies have strong financial standing, solid balance sheets, healthy cash flows. They usually pay off a big dividend. Waste management does in particular. And, the only way that they would have a downturn is if all of a sudden people were to stop reducing their consumption, which is probably unlikely. So, in other words, it's something to sort of keep in touch with as we're going through with that. Next slide. So again, here are some of the competitive advantages. I mentioned some of them before. The number of landfills that they have, the transfer stations, material recovery facilities. And, I know even here in Baltimore, right next to me is a large apartment complex. So they cannot use the municipal services here. So they contract out, and Waste Management is there 2, 3, 4 times a week taking stuff out of there. And they have numerous contracts like that all around. So they have to have a large transportation network, and they do. Look at how many trucks they have. They also can move stuff by rail. They are using technology to be able to keep things going up. That being able to track where their trucks are, and being able to manage the drivers to be able to make sure that they don't overextend themselves. They also sit there and can make some. They have also been expanding with Stericycle in the medical waste, and they're expecting that with Stericycle acquisition, that they'll get $250 million in synergy over the next 3 years. Next slide. So again, here's how they really drive things. It's really through mergers and acquisitions. They do have a strong pricing power because people are not going to cut down on what they're going to pay to get rid of waste. And they also, because they're very technologically efficient, they have really good margins and efficiencies. So you see that in some of their management numbers that go on as well. They are also expanding into some of these high growth, high margin markets, particularly like we talked about with Stericycle. And they're also doing stuff in sustainability and renewable, being able to take that trash and being able to separate it into stuff that can be used again. Next slide. So again, I won't read you all of these, but look at all the acquisitions. And this gets back to what we were saying, is that they are constantly acquiring different companies, whether it's wastewater disposal companies, whether it's stuff in Canada that they're doing. They have stuff like the Waste Away Group in terms of document destruction services on top of just regular trash. So they've done 24 acquisitions just in 2024. Some of them are relatively small, but they generally build out into the entire thing, and that because of it, they have this huge economy of scale that goes on. Next slide. So one of the things that if you look at some of the analysts that talk about it, and this comes from Perplexity AI Insights, and goes, what are the ones that offer the best growth potential going forward if you just use AI as posing a question? And you see some of the ones that show up a lot. Waste management's up at the top. You can be able to see, I have to get on my glasses to be able to see them all in here. But again, there's Republic Services, a competitor of theirs. You can also see a whole range of other companies that are in this area. And again, most of them have reoccurring revenue that comes from this. And at the top of the list is really waste management. Next slide. They also do really good at dividend growth. One of the things Ken likes to do is, he has this in an income portfolio, is he likes to be able to see that they have good, steady dividend growth. And as you can see, they have 21 years of dividend growth streak, uninterrupted for 25 years. And you can see that the rate of growth over the last 5 years is that they've increased the rate by 7.9%. And over the last 10 years, it's grown, the dividends themselves have grown by 7.2%. So that's much faster than the economy over that same period of time. Next slide. So here again is the waste management review from Value Line. And as you can see, some of the standard stuff, if you look at sort of the value line that's in there, it's pretty much fairly valued. You may not necessarily get this when it's really on sale. As you can see, that value line really does track where the price line is. And if you look at the price projections, if you can do that for 28 to 30, if you can circle where that is, Cheryl, where it's 25 to 5% down in there. Those are not really spectacular numbers at 8% and 3%. But like I told you, over the last 10 years, it's grown 2.5 times what it was. So sometimes these numbers in Value Line don't always really give a full reflection of what's going on, because they're not really calculating always the acquisitions that go on with this and sort of build out, and sort of the accretive work that goes on with it. But you can see consistently growing dividends and a company that's continuing to be able to give a good, safe place for dividends. Next slide.
5 minutes.
Thank you. So I'm not going to be able to go through all of the core SSG stuff here, but I like to look at this. A lot of people, when they use core, they never really, they always say you can't really see the visual analysis, and yet you can. If you see this, this is annualized growth. Analyze growth. Anything that's highlighted in green tells you where you are. So we're on the Analyze Growth tab, and the third step is step 3. It's historic stock price review. And that gives you both the sales, the earnings, and the price bar that's in there. The difference is they also get the education that goes on with it. But you can see that these are really good, steady, straight lines that are going through this. And now the current price, that red dash on the I bar up there in 2025, you can see it's trading near its 52-week high. But again, consistent, steady growth. And if you look at the historic numbers down below, all the way down at the bottom, the sales growth historically is 6.1% for sales and 12.1 for growth. The one just below that, Cheryl, you're at the high and low stock price. So if you see that, for a large company, 6% sales growth is really, really good. And then again, the earnings, that's excellent for a company of this size. Next slide. So here's some of the judgment as Ken is put in there. Even though the historic rate is 6.1, they really have shown that an ability over the years to be able to grow at about 10%. Ken is going to go with that. He thinks that's a reasonable number based on where they are because they consistently do have acquisitions that sort of help drive that. Acquisitions will show up on the sales growth line, but you can't always really project for them going forward. And then if you look at the earnings, that's the one in the red highlight in the lower right-hand column. The 10-year earnings growth rate is 12.1, and Ken's estimating 10% for it. So it's a little bit below that, but it's still quite reasonable. So he's going with 10 and 10 for his two numbers for a large size, slow, steady growth company. Next slide. So here again are the high and low PEs. Again, he's projecting a high PE of 34 without any outliers in there. And you can see that gets you to $3.80 or $380.70. The current price is $233.90. So you can tell right away it's not a doubling of it right there. But again, it's not bad for a good, steady growth company. He set his low price, that's in the red in the lower right-hand side. He set his low PE at 26, and that's giving him a low price of 176.80, which is below the 80% rule where we are, and the like. And you could have maybe just as easily had gone with, again, we don't have the ability in core to be able to use the payout ratio like you could in plus, but you can sort of use this as sort of a judgment in terms of where you are. Next slide.
In 1 minute.
Thank you. I didn't have time to be able to put in the upside downside ratio and the like, but as you can see with this final judgments here, the payout ratio is really about 50%. It's been there kind of consistently and the like, but you can see that when you add the potential price appreciation and the yield, you're at 11.7, so call it 12%. That's really not a bad number at all. And if we go one more slide, I have all the conclusion stuff, and make sure to get the SSG on it. So this is a large size, it's a slower growth company, but it is well managed. It's really in the hold zone. It's a 2.6 to 1 upside downside ratio. That payout ratio is really high. The yield is there. It may not necessarily be a buy right now, but it's a good dividend player. And if you sit there, just consider, like I said, it's showing up at the 52-week high. Maybe consider waiting until you buy it on a dip, but this is a well-managed company with excellent financial structure and balance sheets. That's the conclusion. Next slide, and we'll bring you over to Lee, pinch hitting for Brian.
Hey, good evening. I'm Lee Outlaw, and as Kevin said, I'm pitch hitting for Brian, who had an unanticipated conflict. So I'm a volunteer for the DC Regional Chapter, lifetime member. The stock that I'll be doing is CACI International, which is the stock to study for BI Mag this month. Next slide. So this slide just shows you where the report on CACI is in the BI magazine, the pages. It's a very informative overview of CACI in the defense establishment, ecology, information technology market. It lays out its history, corporate targeting, financials, growth trajectories, much of which is going to be addressed in subsequent slides. So I'm not going to dwell on them here. Next slide. So here's a kind of a snapshot of CACI. The SSG was done on the 25th of April. Fiscal year closes at the end of June. It's headquartered in Reston, though Value Line says it's in Arlington, but I think Reston's correct. Information technology sector, it's a medium stock. Now, that 4 on the slide should be a dollar sign. So that means its sales are between 1 billion and 10 billion. So here's a description, offers information services to its customers, supporting national security missions, government modernization for intelligence, defense, federal civilian customers. The above applies that the primary customers are agencies and departments of the U.S. government, which account for the vast majority of the firm's revenue. Company segments are both domestic and international. The company was actually formed in 1962 in Santa Monica, California, as the California Analysis Center, and they did their first job was a simulation programming language program for Rand Corporation. They had their first business deal in 1963, 1970, 67. They became Consolidated Analysis Center. And then in 1986, they adopted its current name of CACI. Current CEO is a person named John Mangiusi, who's 62. He's the CEO and president. Was appointed executive in June of 2019. Before CACI belonged to Lockheed Martin. And then, let's see, Michael Daniels joined the board in 2014 and became chairman in January 2021. Next slide. So the next few slides just highlight the some financials from the recently reported third quarter. CACI provided a very upbeat report on their earnings call, as evidenced by the performance metrics displayed on the slide. Organic revenue growth, EBITDA margin, free cash flow, and their capital deployment. Shown here where they repurchased 436,000 shares. And they do a lot of share repurchasing in CACI. Next slide. So this slide just shows an array of focus areas that they view as well aligned with their current administration's priority. And you can just glance over these. Next slide. So on the earnings call, again, just lays out their strong financial performance, which mostly reiterates what you saw on the initial slide. The only area of concern that they show on this slide is the higher interest rate expense and the tax provisions. Next slide. So based on what they view as a very positive quarter, they've raised their FY25 guidance for the remainder of the year, which is just the last quarter. Based on their assessment, you'll see that, well, let's see, the first two, all they did was up the bottom line band, and then for the adjusted diluted earnings per share and free cash flow, they up the lower bound and the upper bound. Next slide. So this slide highlights a few noteworthy items from CFRA's business summary, and I will note several. As I mentioned, most of the revenue comes from domestic operations, actually 97%. CACI believes a key growth strategy revolves around actively pursuing M&A to expand the base of federal government customers and increase range of solutions it offers. You'll see several of their recent acquisitions in the corporate strategy section of this slides, Azure Summit and Applied Insights. And then I guess lastly, if you look at the corporate landscape, you'll see that CACI competes in a diverse array of very recognizable companies in the federal government sector: Northrop Grumman, Raytheon, Boeing, General Dynamics, et cetera, et cetera. So next slide. So this slide kind of highlights a few things from CFRA's analysis. They have CACI as a buy with a 12-month target price of $510. I think it's $510, which is 52.3% above CACI's price at the time that the Editorial Advisory Securities Review Committee did their analysis, which is in the BI magazine, but it's only 10% above its recent 2-May close. Their buy recommendation reflects expectations of healthy risk activity driven by healthy task order activity, by government sector demand and technology solutions, and further indicates that while DOGE presents risk, CACI appears better positioned due to its specialized cyber and intelligence capabilities, which are among the Pentagon's 18 priority areas which are exempt from broad cuts. And if you'll see on the right, CFRA gives CACI a most undervalued rating of 5. Next slide.
5 minutes.
Okay, so this slide highlights a few things from Value Line. I've just highlighted them with the red indications, the red boxes. On the bottom left, you'll see that their price growth and earnings persistent are very good numbers. On the right, I show their earnings projections and their revenue projections, because generally when I do the growth estimates, I sort of tailor it so it matches the value line, these two value line projections. And just one comment I'll note that indicates the bottom comment that, well, I already mentioned that a value, high percentage of the revenue comes from the federal government, which Value Line and the Editorial Advisory Security Review Committee sees as a risk. Next slide. So Brian used growth estimates at 8.5 and 9.1. Customarily, these slides would show the peers, but for some reason he wasn't able to add those. Next slide. Okay, so here is a snapshot of the Evaluate Management. The pre-tax profit for sales is actually 7.15%, which I looked up, which is above the industry and peer group average. The return on equity is came to 12.26, which is hard to see from the slide, which is also above the industry and peer group average. The total debt and the debt to capital, you'll see, are very high, which I attribute to their recent acquisitions. Next slide. So again, here we have the 5-year sales growth projection of 8.3. Value lines was 10.5. So it's a little lower than value line. However, if you look, you'll see that the projected sales is 11.412 million, which from the previous value line side tracks very well with their projected estimate of 11.115 million. Next slide. Here the EPS estimate 9.3, which tracks or projects 29.01 earnings per share, 5 years, which is a little lower than value lines forecasted 32. Next slide. They're high priced using a PE of 21.2. Average comes to 6.615. Next slide.
1 minute.
Okay, low PE over 10 years comes to 13.9, which continues on the next slide, which gives you your next low price. Low price based on a low PE of 17.2 and EPS of, let's see, EPA trailing 12 months, 21.19, came to 364, which tracks very closely to the 80% current price, which was based on the price at the time of the Brian did his review. Next slide. So here we have the potential gain, which comes to one upside downside range of 1.9 to 1, which is in the hold area. Next slide. And finally, price appreciation. Oh, by the way, CACI does not provide a dividend. Price appreciation for a high PE is 6.5% projected based on this analysis, which is a little lower than the band that you'd expect for a mid-sized company. And the last slide. So here are Brian's conclusions. Medium-sized growth company, well-managed, currently in the hold zone. Its close on the 1st of May was 458. It actually closed, well, I'm not sure what it closed today. I think it's around the 460. Upside downside ratio I mentioned is 1.9 to 1. 10-year CAGR 20.4, no dividend. He considers it worth starting or adding to a long-term position using dollar cost averaging if the sector and size improve your portfolio. And that's what I have from Brian.
Thank you very much. And again, I really appreciate you stepping up and helping out, Lee. So now we have 2 stocks that are going to be done in plus, and they actually are prepared. First one will be Cheryl. She's going to talk about Green Brick Partners. And then afterwards, the undervalued feature is going to be done by Richard Aronson on NextEra Energy. And again, here's a reminder. Please make sure to be able to get the completed SSGs and the handouts by going to the handout section right now. And over to you, Cheryl, and get us going.
All right. So I'm Cheryl Patterson. I am currently the president of the DC chapter and a member, as I stated before, of McNova and Happy Destiny, along with Kevin. Green Brick Partners founded on the predefined screens, both the A-list stocks and the roster of quality. And it is on the NDQ with a ticker of GRBK. So this presentation is the follow-on to Kevin Galogli's study of the housing industry. Green Brick is now traded, as I said, under that ticker symbol of GRBK on the New York Stock Exchange, and it was added to the Russell 2000 in 2015 and the S&P Small Cap 600 Index in 2022. Additionally, Green Brick has been named by Fortune magazine as one of the fastest growing public home builders and land developers in the country for 5 consecutive years. It was founded with a vision of integrated the often disparate world of building materials and real estate development. Its founders recognized an opportunity in the early 2000s, a need for a more cohesive approach to housing construction that address both the supply chain of quality building products and the complexities of land development. By aligning manufacturing excellence with real estate expertise, the company aimed to fill a gap that other industry players had not effectively bridged. Green Brick is the third largest home builder in the Dallas-Fort Worth area. They are a diversified home building and land development company that operates through its 7 subsidiary home builders in Texas, Georgia, and Florida. Over the last 10 years, they have been committed in building high-quality neighborhoods in some of the best markets in the country, interwoven with modern technologies, innovative design, and architecture. Their strategic advantages in sourcing and self-developing land in infill and infill adjacent submarkets, as well as expert local teams, have been instrumental to their growth and expansion over the last decade. Their unique approach provides superior value to consumers, their communities, and long-term returns for investors and stakeholders. Due to strategic acquisitions in land, real estate, materials, and financials, Green Brick is currently the gross margins industry leader among the peers. Green Brick Partners seek a strong future with millennials reaching the prime age when individuals and families look into buying a home. This population segment growth is expected to be 2.4 million over the next 10 years. Meanwhile, the existing home industry at 1.2 million and unsold new home inventory at 500,000 is not scheduled to meet the coming demand. Green Brick's strategic advantages in the home building industry included footprint in 2 of the best markets of Dallas-Fort Worth and Atlanta, Georgia. Limited competition from existing inventory due to mortgage lock-in rates of 4% and 5%, superior lot and land position in the most desired with over 37,000 lots owned and controlled as of September 30th, 2024. Finally, they have a strong balance sheet. Operating cash flow and total cash on hand was $80 million, with $360 million in undrawn lines of credit and one of the lowest debt to capital ratios among peers at 12.5%. 100% of outstanding debt is under a fixed interest rate of 3.4%. Here's a picture of their fall 2024 development that includes green spaces and desired amenities. So picture's worth 1,000 words. Green Brick Partners has one of the lowest cancellation rates in the industry, with increasing quarterly starts since fourth quarter 2022. 2024 annual highlights include a 20.3% increase in new homes delivered, a 4.7% increase in net new home orders, and a 20.5% increase of units under construction. However, the average sales price of homes delivered dropped by 4.7%. Green Brick Partners has a 5-star quantitative rating and is currently traded at a 22% discount when comparing the May 2nd stock price to their fair value. The company's high profitability makes it more resilient in recessions and more likely to generate strong cash flow. The SSG Plus graph shows an up, straight, and parallel lines, with the exception of the first quarter, where they were punished by the market for missing their EPS estimates by 2% and revenue by 1.6%. Looking ahead, however, revenue is forecast to grow 1.2% on average during the next 2 years, compared to a 4.3% growth forecast for the consumer durables industry in the US. Also, the top price is currently a little less than halfway point. With historical sales, GBP is 2% second only to Dreamfinders Homes in both the average 10-year growth and recent quarter rate. With historical earnings per share, GBP has the top 10-year growth rate and is second to Dreamfinders with recent quarters. Sales and earnings per share are estimated to grow at 8%. For a medium-sized company, 7 to 12% is the average per year, so they are slightly above. I'm sorry, thank you.
Oh, sorry.
GBP has a slight edge over its direct competitors for the last 5 years' average of pre-tax profit on sales. It's not. There we go. All right, so this is looking at the pre-tax profit on sales, which I just read to you. All right, the competitors are about even with each other for return on equity, but all are well above the last 5-year industry average. Green Brick has one of the lowest percent of debt to capital percentages, especially in the year ago quarter change, which is negative 19.9%. Analysts' 2-year sales estimate is 8.2%, which results in an increase of 2.5 million using a quarter projection point starting point. I used an 8% estimate with the same starting point that results in a 5-year projected sales of 3.2 million. I also used 8% for an earnings per share growth rate increase that results in a 5-year projected earnings per share of $12.17. With a current stock price of $60.20 and a forecasted low price of $43.90, that results in an upside downside of 3.6 to 1 and a total return of 14.6%, which aligns with the par that I found in another program of 14.3%. Conclusion: Green Brick is a medium-sized company with a Morningstar Financial Health grade of B. It's a well-managed company, and while Green Brick is currently overpriced, trading above its 5-year average high PE, it is a buy up to the $62.70, which the buy price to satisfy a 3-to-1 upside downside and 15% total return is $59.30, which may be reached in this volatile market. Green Brick is definitely a worthy candidate for watch list. And that is my report.
Thank you, Cheryl. And last but certainly not least, Richard will be able to tell us about NextEra Energy. Take it away, Richard.
Thank you, Kevin. NextEra Energy is listed on the New York Stock Exchange under the symbol NEE. It was in the May 2025 Better Investing magazine as the undervalued feature stock. Next slide, please. Okay, this is just it's in the utility sector, regulated electric. It's a large company with sales of $24.8 billion. Next slide, please. So NextEra Energy is actually comprised of two large companies. The first is Florida Power and Light, which is one of the largest electric utilities in the US and the largest electric utility in Florida. It also represents 70% of NEE sales. The other company is NextEra Energy Resources, which is a world leader in renewable, such as solar and wind power generation, as well as storage battery. A subsidiary of NextEra Energy Resources is NEET, which is their transmission line company. And they report to NEECH Capital Holdings, which handles all the financing for the corporation, as well as commodities and futures market trading. The combined company has a broad array of capabilities in renewables and storage. They do fossil fuel generation, natural gas, as well as nuclear operations, power delivery and transmission. They have an extensive supply chain, and they're converting that more and more to US suppliers. They do their own engineering and construction, and that gives them a broad market knowledge and data and analytics to constantly innovate and improve their performance, plus combined with a strong balance sheet. Next slide, please. Their 20-year performance is quite impressive. Their earnings per share growth has been about 9% compounded annually. Dividend has been growing at about 10% compounded annually, with 31 consecutive years of dividend growth. Operating cash flow is increasing at about 8% rate, and the 20-year total shareholder return is more than double the S&P 500. Next slide, please. So NextEra Energy believes they're well positioned to continue earnings growth in the 6 to 8% range for the next several years, as well as continue their 10% annual growth rate at least through 2026. Next slide, please. So let's talk a little bit more about Florida Power and Light. Next slide. As I mentioned, it's one of the largest electric utilities in Florida and one of the largest electric utilities in the US. It gets its revenues from power generation, transmission of power, distribution, and sale of electric energy in Florida. The rates that they can charge would have to be approved by regulatory bodies. In general, under US and Florida law, regulated rates are intended to cover the cost of providing service, including a reasonable rate of return on invested capital. Therefore, there's no guarantee that Florida Power and Light will earn any particular rate of return or recover all of its costs through regulated rates. I would have to temper that statement with looking at its past history for the last 20 years, and it's done quite well serving Florida. Next slide, please. Their customer base has been growing consistently. In the last 3 years, it's growing at about 1.3% per year, and their capital employed growth is growing at about 12% rate. They also have one of the lowest rates in the country, where Florida Power and Light charges about 40% lower rates than the national average. So they've been doing quite well from a performance standpoint, and usually are looked favorably upon the regulatory bodies. Next slide, please. A little bit more about NextEra Energy Resources. Next slide. So NextEra Energy is a leading clean energy company. It's one of the largest wholesale generators of electric power in the US and 4 Canadian provinces. NextEra Energy owns, develops, constructs, manages, and operates electric generation facilities. It's the world's largest generator of renewable energy from wind and sun-based, as well as world leader in battery storage. NextEra Energy also engages in energy-related commodity marketing and trading, and we'll talk a little bit more about that in a short while. Next slide, please. So NextEra Energy believes they're well positioned to capitalize on a large growth in energy demand in the United States. And today they deliver about 38 gigawatts of power, and in a couple of years they expect that to double to 81 gigawatts. That's based on backlog and their projections going forward. They have the scale and the experience and technology to grow their renewable and storage portfolios quite well. And they also can create value for their customers and shareholders by completing the increase. Next slide, please. So a number of resources and studies have indicated that expect a large inflection point in power demand in the US going forward. Energy Information Administration has forecasted that, in the last 20 years, energy growth has been growing at about 0.4% per year. And they expect that to increase sixfold in the next 20 years to grow at 2.24% compound annual growth rate. Grid Strategies projects similar growth in the next 5 years, growing at 3% compound annual growth rates. And McKinsey Energy Solutions is forecasting that renewables and storage deployment will, in the last 7 years, has been about 140 gigawatts of power. And in the next 7 years is going to grow to 375 to 450 gigawatts of power. That represents a 15 to 18% compound annual growth rate. Next slide, please. So where is that coming from? So after decades of flat demand, load growth has materialized quickly across many parts of the US. The US Census Bureau is showing that annual construction spending for manufacturing has been pretty flat in the last 20 years, and that's expected to increase at a 4 times rate moving forward. The manufacturing plants that they construct consume a lot of electricity, so that makes sense. The oil and gas industry is expecting a projected growth rate greatly exceeding the historical average. Did a little research to understand how that affects electricity, and it turns out the fracking, wastewater pumping, as well as gas pumping and through the pipelines requires a lot of electricity. So that increases the large demand for electrical power as well. And finally, data centers for cloud computing, artificial intelligence, and crypto mining is expected to grow at a compound annual growth rate of 22% in the near future. So there's a tremendous electrical demand growth that's expected. Next slide, please.
5 minutes.
Okay. So right now, unplanned natural gas generation is at least 5 years out, and new nuclear plants to supply electricity are at least 10 years out. NextEra Energy believes their renewables and storage can fill the gaps now and in the future, and greatly increase the renewable and storage in the country. Next slide, please. So let's take a look at the stock selection guide analysis and judgments. Next slide, please. So the first thing I noticed when I looked at the front side of the SSG was the earnings and pre-tax profit kind of lumpy roller coaster. So I did a little research to see what was going on. And in 2017 and 18, the earnings increase was due to disposal of a business. That's shown by the A in parentheses. In 2019 and 2020 and 21, they had about $2.2 billion in losses due to a hedging activity, which seems to be an ongoing event. In 2020, dip in earnings was primarily due to an impairment charge related to an acquisition. That's a one-off, so that's where the bottom in 2020. And finally, the first quarter of 2025, there was a large dip where they borrowed to fund investments, and that decreased the earnings. So that's D. So you can expect that to continue in the future. And I looked at some of their peers, and that many of them have the same up and down earnings slope. Next slide, please. Next, I looked at the sales and earnings judgments, and I listed all of the estimates that I could find. I decided to remove the Morningstar and analyst consensus estimates as being an outlier, as well as the historical earnings growth of 5.8%, although that makes very little difference in the actual average that I computed. So sales growth average was 6.9% was my first judgment. Earnings growth was 6.8%. Next slide, please. So the current price is actually near the bottom of the 52-week range. On the right in the oval, you can see that the first quarter earnings per share year over year had dropped 63%, so quite a dip. And you can see that on in the earnings that were down, which I discussed earlier. And if you look at the total debt, it peaks up somewhat, showing that the debt that they just took on is driving down the earnings. Next slide, please. From an evaluate management standpoint, NextEra Energy comes out on top of its peers and its industry average across the board for pre-tax profit on sales, return on equity, and debt to capital. Next slide, please. Next up was the high and low PE judgments. I looked at the 5-year average for the high PE, which was 40.5, but I noted a downward trend from 2020 to 2024, going from 56 to 25. And the industry average was 25.8. So I wanted the industry average, the judgment for a high PE to be slightly above the industry average, and certainly closer to 25 than 40. So my judgment that I chose was a high PE of 27. For low PE, it's a similar event where was a trend down. Industry average was 19.1. And the low price at 80% of the current price turned out to be $53, or a low judgment, a low price, a low P to E of 20. Next slide, please.
1 minute.
The upside down to downside ratio turned out to be a surprising 4.6 to 1. And the total return for the high PE was 16.5, which is very high for a large company. Projected return for the average PE was 13.8, still quite high for a large company. Next slide, please. So in summary, energy demand is projected to grow 6 times faster in the US than it has in the last 20 years. And NEE is in a good position to capture part of that demand. It also combines the best of 2 worlds, with Florida Power and Light projected to continue consistent growth, plus a 3% dividend growing at 10% annually. And then NEE Resources is expected to double energy storage over the next 2 years, as well as further out in the future. They have an advantage in wind generation, as they were early investors and have securing some of the country's most desirable locations. Their management stands out among its peers, and with an upside downside ratio of 4.6 to 1 and a total return of 16.5%, it's excellent for a large company, and I would consider it undervalued and a good candidate for your watch list.
Thank you, Richard. So we went through all these stocks fairly quickly, But the thing is that we like to ask all of our presenters to be able to tell us where it sort of fits on this life cycle. And for those people that are new, let's go to the next slide and we'll sort of explain where it comes from. This is T. Rowe Price, and he talked about how companies all sort of had a life cycle of growth, maturity, and decadence. And as you can see, they all seem to be kind of put in that same spot. And I'll start with Waste Management, WM. I have it more like towards the mature growth there. Again, it's not going to be a huge grower, but again, it does stuff through acquisition. It has an excellent balance sheet, and it also pays out 51% of its earnings in terms of dividends. But I think it's in a good spot and can sit there for a long time. Lee, tell us why you have CACI there.
Okay, so I'm going to share Brian's thoughts. CACI has been around the major contracts business for a number of years. It's aggressive company acquisition program, along with an aggressive share repurchase program, are positives for CACI to continue to excel in upcoming business cycles.
Thank you. Cheryl, tell us why you picked that location for Green Brick.
Well, Green Brick, through its selective land acquisitions and company acquisitions, have, along with setting most of their finances at a 3.4% interest rate, is really poised to move ahead from where it has been earlier in its life. And so, even though it has been around for a while, I still see it as something that could still have a good impact in terms of being in the selective areas of the country that they are.
Okay, thank you. And Richard, why do you have that location for NextEra Energy?
NextEra Energy is a very large company with growth of about 7%, but 70% of that company is Florida Power and Light, which is a mature, slow grower. But an added kicker is the NextEra Energy Resources, which is more of a growth company. So I put it near the beginning of the mature range. It still has solid growth and a little extra growth from its NextEra Energy.
Okay, thank you very much. Let's go to our next slide. We've been talking for about an hour or so. Now it's time for you guys to talk by voting. And Cheryl, if you can be able to release the poll, and we can be able to let you all do that. And in the meantime, once you're done voting, think of some questions you can be able to ask, and Lisa will sort of divvy out the questions as they come on out on any of the four companies you have here. All right, I see we've got about 40% of you voting. Good steady voting, keep it up. Just cross the 50% mark. Got over to the 60% mark. Can I get any higher? Looks like we sort of hit a speed bump there. I don't see any movement. Why don't you go ahead and close it up?
All righty.
And share that with everyone so they can see who the big winner is. And it was Green Brick. So again, thank you all for participating in that. You can see that we actually had a couple that were fairly close head to head there. Lisa, do you see any questions? I've been looking there. I haven't really seen too much there.
Nope, I don't see any questions.
Yeah, we got too many shy people in here. We're giving you all this hard work and no one wants to be able to test us with questions. Go ahead and raise your hand. We can actually open you up. Or do we have a question coming?
One just came in. Regarding NextEra Energy, it was in the buy zone by the presenter. So recommended that it be put in the watch list. Did I hear him correctly?
Yes, I always put things that even if they're on a buy indication in a watch list, because you still need to do your own research. Mm-hmm. So I think that's important.
Okay, I agree. Any other questions?
Or you can raise your hand.
Yeah, that's true. Yep.
We do have a hand raised. I'm going to unmute Freddie. If you're self-muted, so see that microphone icon, unmute yourself and ask your question. Can you get there? See the microphone over on the right-hand side? Go ahead and click on that microphone icon and it should turn to green and you'll be able to speak. Try that, Freddie, because you're self-muted. All right, while you're working on that, I'm gonna, I see John. I've unmuted you, John, so go ahead and ask your question.
In preparing these research topics or research on these companies, it looked like the first two were done with core SSG and the last two were done with plus.
Correct.
Was there any advantage or any I guess is there one that's better than the other? We currently use the core. We were considering moving to plus, but I'm not sure if I understand what the true differences are.
Sure. What's the name of your club? Let's hear about it.
TI Investment. See, we were established in 1996.
Okay.
I joined later in 2002. And we're all over. We started out with maybe almost 30 partners because we had all gone to college together. We just used this as a way of keeping in touch as well. So from 96 to now, we dwindled down to approximately 4 partners. And let me see, I'm in Virginia. No, one partner's in Maryland, I'm in Virginia, another's in Virginia, and another's in North Carolina.
Okay. And so you're all using core right now, right?
Correct.
Well, it does cost a little bit more to use plus. It's really not that much of a marginal difference. There are just some more additional features that you can use. And those of us that have been around a while, we find it easier to move back and forth around the SSG with the plus. But you can certainly do a very strong completed SSG with core. And, if you want to, you can just learn how to use additional features with it. One of the reasons we do 2 in core and 2 in plus is because exactly there are a lot of people that do use core. I personally use plus most of the time, but I find it good sometimes to use a core just to be able to sort of understand some of the basics because that's what it really emphasizes. If you want to learn more about it, I can reach out to you. I'll get your email here and I'll send you an email and we can talk more offline.
Okay, sounds great.
Another interesting thing about using core is you can then insert peers of the company that you are studying and see how your company is doing in comparison to those peers in several different areas. So it really establishes in your mind whether you're studying the best of the best. And it's one way to look at it. It's not a definitive of being the best of the best, but to then give you an idea, maybe you should study one of the peers as well.
That's a very good point. One of the things we do like about the core is that sometimes when it generates the peers automatically and you start to look at it, you say, well, these aren't exactly the peers. So you can go in and actually replace the companies that are in there in the core version.
Yep.
And we like that feature.
Oh, I definitely, in the green brick, when I looked at the peers, I changed them, all of them, to reflect what other properties and other resources had said were the top of the top.
Right. Okay, great. Thank you all.
Lisa, looks like we have a couple questions. You want to read any of them out?
I already read one, and then one was just a comment that Richard liked NEE.
Okay.
And I had one question where someone had asked where to find the handouts. which it's on the GoToWebinar control panel, and you kind of scroll down, it's the dark gray areas, and it'll say handouts, and click on that, and you'll be able to see all of them.
I'm circling them with my cursor right now.
I don't think
So
they can
here's
see
the
it. They
handout.
can't see it because it's just on your stuff.
Yeah.
It's just on
I see. Okay.
what Lisa was saying. It's on the control panel where that arrow is. Just sort of open that up, and you can be able to do, as she said, the down arrow, and you'll be able to see where where it says handouts. Any other questions we have, Lisa?
Nope, not at this time.
Okay.
And if anybody has any problems with downloading the handouts, we'll be giving our emails shortly, and you can shoot me an email, and we'll see about getting them to you.
I think we got one more question there, right, Lisa?
Oh, okay. Oh, it popped up. Yep. What do you think will be the interest rate sensitivity on green brick?
Well, the interest rate right now is they have a fixed 3.4% and an unused line of credit of 300 million. So they've got a good amount that they have good interest rate against that they can use for, you know, as long a period of time as it lasts. So they've kind of prepared themselves for increasing interest rates by doing that.
Okay. Tom, since you asked that question, what I'm going to do is I'm going to unmute you on our end. If you want to be able to unmute yourself, you can do any follow-up questions on that, Tom. See where the microphone icon is. There you go.
Well, it sounds like they've got that fixed interest of 3.5% is going to allow them to fix some of their expenses. So I think that's a good thing. So
yeah, they were planning ahead, and I think a lot of companies have been doing that, and that's what's hurt the banks a lot is they have a lot of low interest loans on their books.
Tom,
well, thank you.
Do you own Tom? Do you own Greenbrick or any of the residential construction companies?
No, I do not. I do not. There's just too many. It's too volatile right now. At least that's my thoughts at this point.
Well, I ended up doing one of these for the Manifest Roundtable, and what I found out is that over the last 5 years, just about, I think it was like 12 or 15 of them doubled their money in the last 5 years, even though everyone was talking about how everything was going to be bad post-COVID. And so it really sort of opened my eyes to taking a look at more of their residential construction. I don't own one yet, but I've done enough studies that I'm ready to purchase one of them. I'm digging in. Greenbrick's clearly one of the three I would look at. The others being
sounds like I need to do a little more study.
Yeah. I also like Toll Brothers and Dream Finders. So,
well, one of the things that really interested me was the fact that millennials are coming into the age group where they're going to be thinking about buying a home, and so has been the housing market has been underwater for quite a time. They just don't have the inventory out there, and some of the inventory they have out there, people aren't giving up their homes because they've locked into that lower mortgage rate. So that's really going to make a dent on it, and also the fact that they are building most of the builders that we talked about are building in that southern eastern to central area, which seems to be where the population is increasing the most.
Yeah, good point. Good point.
So, Tom, are you in a club?
Thank you.
Are you in a club, or do you? I see you as a regular over here.
Yeah, well, I'm actually with the Rocky Mountain chapter.
Okay.
And in fact, I invited you to come to our
That's right. I recognize your name and I couldn't remember it. Don't become old and senior like me because you forget. I
well,
saw
I
I saw your
resemble that.
name and I'm like, why do I recognize this one? So that helps. Anyway, appreciate it. I see there's a couple other people from Rocky Mountain in here, so thank you very much for all of you. Lisa, any more questions?
No, no more.
Well,
Well,
I think
I would like to put a shout out to any of the clubs in the DC regional area that we are doing club visits, and there's nice perks that go along with it. So please contact us if your club would like to have a director come and do an educational session with your particular club. Depending on how far away you are from us, we can do it in person or we can do it virtually. And we've had some very positive remarks from our visits in the past.
very good. Let's finish up. We have just a few more slides left. And this is where Cheryl was saying, if you need to reach any of us, here's where everything comes from. There's a picture of a bunch of us that have done presentations. That was at Pink last year in person. We've had over 40 different people make presentations for this program. And we're really proud and happy of all the different clubs and directors and non-directors that have participated in it. So there's our contact information. Next slide. This is how you can get on our mailing list. You do not have to be a DC regional chapter member, nor do you have to be a BI member. Just sign up and you'll get notices on stuff we're doing in our chapter. We don't inundate you with a whole bunch, but we do want to be able to communicate with you. Next slide. Lisa, why don't you tell us all about volunteering?
All right, well, the Maryland and DC chapters are run entirely by volunteers, just like everybody tonight. And the directors are really the heartbeat of the BI investing group. And volunteering is a great way to learn more about investing. And I can speak from personal experience on that. So definitely volunteer. It's a great way to learn new skills, perfect, doing the SSG. You can do it with groups of people. It's great. They have a lot of local events and a lot of meetings are done online now. So it's just great all around. I can't recommend it enough.
Thank you, Lisa. And thank you for also stepping up at the last minute to help us out. Next
You're
slide.
welcome.
So here's what we're going to be doing next month. In fact, I see two of our presenters are in the audience tonight, but our stock to study is Lowe's and our undervalued feature is Icon. And we have two more that are still to be determined. I'll try to nail that down in the next week or so. And then we also have a couple openings, not in May, but in June and July. We have openings for presentations. So if you're in the Maryland, DC, or Virginia area, and you want to be able to feature your club, even if you don't feel comfortable doing stock presentations, Cheryl or I or any of the other directors will be more than willing to work with you. We have a template and we won't leave you hanging. We'll do everything we can to build you along because that's what we do in Better Investing. Is we want to be able to help everyone out. And like I said, we've had over 40 presenters. We've had 40 exactly different presenters in the almost 5 years we've done this. So we're really proud of all the people that have participated and helped and stepped up. And we'll do the same for you and for your club. Next slide. We also have stuff up on Manifest, although I have to admit most of the stuff from 2025, I'm horribly behind in getting the dashboards up and running there. But you can see some of the older ones to take a look at it and the like. But there's all the different ways we put them together. And we go to the next slide. You can see hyperlinks for all of them. Again, these are free. You don't need a subscription to Manifest to be able to take a look at this, and you can sort of track how they've done over time. And make sure to download that handout so you can get these hyperlinks for where they are. Next slide. So that's really it for tonight. Do we have any other questions up there, Lisa? I think we're pretty much caught up, right?
Yeah, I don't see any more.
So again, here's the hyperlink to the YouTube page. Hopefully I'll have it up later on tonight or maybe even early tomorrow morning. And we appreciate you being here. We're getting good, steady growth here. We're glad that you're with us. Please share this with other people in your community. Come back next first Monday of the month in June, on June 2nd, where we will again dig into the BI and find more to be able to look at in terms of stocks. Thank you for being here. Good night, all. And we'll keep this open for a little bit for people to get those handouts.
Yes. Now we had 263 people register. I think that's an all-time high.
It is. It's not translating into additional. We got an uptick in number of people attending, but
Mhm.
How many attended tonight?
you can see under organizer, but we had at our peak was 55 attendees, but with people coming and going, it was probably more like 65, plus the 5 of us in the background, and that's a pretty good number.
Yeah.
Not quite the same as Manifest, where they end up getting like about 200.
Yeah.
But
Okay.
55
Well, good
is a
night,
good
all.
number. Thank you very much, Lee. Yeah, we really appreciate your stepping up.
Sure thing. Bye-bye.
Good night.
Good night, Kevin. Good night, everybody.